All right, let's dive right in. We all know cash is king in any business right now. It's the absolute lifeblood. And the system that keeps it flowing is the revenue cycle.
Absolutely. For this deep dive, we're focusing on something really crucial for businesses: how they account for the money customers owe them and the revenue they generate from sales.
Right. And you, our listener, send us some really interesting material on receivables and revenue. We're going to break it down and extract the most important insights. No need to get lost in the accounting jargon.
A key challenge for businesses is that tricky time gap between earning revenue and actually seeing the cash. We're going to unravel that today and explore what happens when they can't collect everything owed to them.
To make this even more real, we'll be using Apple Inc. as our example throughout. In their 2016 fiscal year, they had a massive $215.6 billion in net sales revenue. And their accounts receivable, basically the money customers owed them, stood at $15.7 billion.
Yeah, just a tiny fraction, about 7.3% of their net sales. This really highlights how efficiently Apple turns sales into cash. It's a sign of their strong bargaining power, allowing them to set faster payment terms. On top of that, their allowance for doubtful accounts, what they expect to not be able to collect, was a mere $53 million.
Wow. Just a tiny fraction of their sales. And they were holding a huge $67.2 billion in cash and assets that are almost as good as cash. So how do businesses determine when they've earned revenue?
It all starts with GAAP, generally accepted accounting principles. The core idea is revenue recognition. Basically, a business should recognize revenue when it delivers goods or provides services to customers for the amount it expects to receive.
So it's not about when the money's in the bank. It's more about when the job's done. And the material you shared outlines a 5-step model. Could you walk us through those steps?
Absolutely. First, you identify the contract with the customer. This could be a formal document or even a verbal agreement, as long as it sets clear obligations for both sides.
Okay, step 1 done. What's next?
Step 2 is identifying the performance obligation in the contract. What must the seller do to earn the revenue? If it's a product, it's delivery. For services, it's performing the service.
Got it. Now, how does the actual money come in?
That's step 3, determining the transaction price. This is the cash or the fair market value of whatever the seller expects in exchange for the goods or services.
All right, and what about step 4?
Step 4 is about allocating that transaction price to each performance obligation. If a seller has multiple promises in the contract, the total price needs to be divided accordingly.
And finally, step 5. That's where we actually see revenue hitting the books, right?
Exactly. Step 5 is recognizing revenue when the entity fulfills its performance obligation. This means the seller has done what they promised to earn the revenue. For products, it's usually when ownership transfers to the customer. For services, it's when the service is essentially complete.
So there's a difference between selling a cup of coffee and a long-term software subscription.
Absolutely. With a simple transaction like coffee, the contract's implied. You buy, you pay, revenue recognized. But larger companies often have complex contracts with multiple performance obligations, like selling equipment with installation and maintenance. Today, we're focusing on the simpler, single obligation contracts.
Speaking of real-world examples, Exhibit 5.1 shows Apple's revenue recognition policy for product sales. Anything interesting stand out to you?
Well, it's interesting that Apple mainly recognizes revenue upon shipment. This aligns with the idea that ownership transfers then. However, there are exceptions. For online sales to individuals, some education sales, and specific others, revenue is recognized on customer receipt because Apple bears some risk during transit.
Makes sense. They haven't fully delivered until it's in the customer's hands. The exhibit also covers price protection and anticipated returns. These are treated as reductions to revenue.
Right. With price protection, if the price drops, customers might get a refund, so that potential obligation needs to be factored in. Similarly, they estimate future returns based on their experience and reduce initially recorded revenue. But complex bundles with multiple elements are outside today's scope.
Okay, let's use an example. Apple sells 30,000 iPhones to AT&T for $100 each, with a cost of $60 per phone. Can we apply the 5-step model? So, starting with the contract.
The contract is Apple shipping 30,000 iPhones, and AT&T pays, say, within 30 days.
Step 2, Apple's obligation.
They must physically ship those iPhones to AT&T's designated location.
Step 3, the transaction price. And didn't the material mention trade discounts here?
Yes. Let's assume the regular price for these iPhones is $125. But since AT&T is a major customer, Apple might offer a 20% trade discount. So the transaction price becomes $100 per phone, $125, $1 2020, totaling $3 million. Trade discounts are common for businesses to offer different pricing without changing their main price lists.
Step 4. Allocating that price. Seems simple here with one product.
It is. With one delivery obligation, the allocated price is simply $100 per phone.
Now, step 5. When does Apple recognize the revenue? Considering they mostly use FOB shipping point.
Revenue is recognized upon shipment. They've done their part, and ownership, along with payment responsibility, transfers to AT&T.
What's the journal entry Apple would make to record this sale?
They would debit accounts receivable for $3 million, increasing the asset representing the money AT&T owes. And they'd credit sales revenue for $3 million, recognizing the earned revenue. Since they use a perpetual inventory system, they also need a second entry, debiting cost of goods sold for $1,800,000, 30,000 iPhones at $60 cost, and crediting inventory for the same amount, reflecting the decrease in their stock.
We've talked about FOB shipping point. The material also mentions FOB destination. What's the key difference?
The difference is when ownership changes hands. With FOB shipping point, ownership and revenue recognition happen when goods leave the seller's dock. With FOB destination, it's when they arrive at the customer's place. And Apple mainly uses FOB shipping point.
When AT&T eventually pays, what entry does Apple make?
Simple. They debit cash for $3 million, increasing their cash, and credit accounts receivable for the same amount, showing AT&T no longer owes that money.
So every business wants faster cash flow. What are some common ways to speed things up?
Many tactics exist. Sales discounts for early payment is a big one, and we'll get into the details later. Some charge interest on late payments. For retailers, accepting credit and debit cards can really accelerate collection, even though it comes with fees.
Right, there's a cost to those card transactions.
Absolutely. Those companies usually charge a percentage, often 2% to 3%. Businesses get cash fast, but at a small cost.
What's the entry for a credit card sale? Say, Apple sells a $5,000 computer with a 2% Visa fee.
Okay, so Apple debits cash for $4,900, the sale price minus the $100 fee, 2% of $5,000. They then debit credit card discount expense for that $100, and finally credit sales revenue for the full $5,000. Important note, this credit card discount is usually reported as interest expense on their income statement.
Now, what if things aren't perfect and a customer needs to return merchandise?
That's when sales returns and allowances come in. Customers can often return unsatisfactory or damaged goods for a refund, credit, or exchange.
And businesses can't just wait until a return happens. They also need to estimate future returns.
You're absolutely right. At the end of each reporting period, companies estimate expected returns based on their history. Apple, as per their policy, also reduces recognized revenue for these expected returns. This involves adjusting inventory and cost of goods sold to account for anticipated returns.
So what if Apple estimates a 1% return rate on their June 2018 sales revenue of $200 million? Let's assume the cost for those returned goods is 60% of the sales price. What adjustments would they make on June 30th?
Okay, so on June 30th, they would make two adjusting entries. First, they would debit sales returns and allowances for $2 million, representing the estimated returns, 1% of $200 million. Then they credit sales refunds payable for the same $2 million, a liability showing what they expect to refund. Secondly, they need to adjust inventory. They debit inventory returns, estimated for $1,200,000, 60% of the estimated returns, and then credit cost of goods sold for the same amount, reflecting the likely return of those items.
And then what happens when customers actually return those goods in July?
They reduce the sales refunds payable. So if $8,800,000 worth of inventory is returned, Apple would debit sales refunds payable for that amount. They then credit either cash for a cash refund or accounts receivable if it was originally a credit purchase. They would also debit inventory for $1,080,000, 60% of the returned $1,800,000, and credit inventory returns estimated for the same amount, clearing out that temporary account.
Earlier, we talked about sales discounts as a way to encourage faster payments. Can we dig a little deeper into how those are recorded?
Sure. Sales discounts are incentives for customers to pay early. A common way to express this is 2-10 and 30, meaning a 2% discount if paid within 10 days. Otherwise, the full amount net is due in 30 days.
Let's say Ace Hardware sells $100,000 of lumber on account to Sorrell's Construction with these terms, 2-10 and 30. The cost to Ace was $75,000. How would Ace record this initial sale?
Ace would initially record the full $100,000 sale, assuming the customer won't take the discount. This is the gross method. On June 30th, let's say, they would debit accounts receivable Sorrell's Construction Company for $100,000 and credit sales revenue for the same amount. They would also record the cost of goods sold. debiting cost of goods sold for $75,000 and crediting inventory for $75,000.
So if Sorrells pays within 10 days to get the discount, what happens on Ace's side?
If Sorrells pays on July 10th within the discount period, they only pay $98,000, which is $100,000 minus the 2% discount, $2,000. Ace would debit cash for $98,000, debit sales discounts for $2,000, and credit accounts receivable Sorrells Construction Company for the full $100,000.
So sales discounts reduce the revenue Ace actually gets. And the material talks about companies like Apple presenting net sales revenue. What does that mean?
Net sales revenue is a big deal. It's the total sales revenue minus sales discounts, returns, and allowances. It shows what a company actually earned from sales. Apple's statements clearly show their net sales for several years, demonstrating this net presentation on the income statement.
And recognizing revenue has its ethical side, too. The Cooking the Books spotlight on OCZ Technology Group really emphasizes this.
Definitely. Improper revenue recognition can be a big deal, and this case illustrates the potential risks and consequences.
What are some common ways companies might manipulate revenue? Red flags to watch for.
Well, some might record fake sales to non-existent customers, others might inflate sales figures, some might hide actual returns. Then there's misclassifying discounts and channel stuffing, where distributors are pushed to buy more than they can sell. And there's manipulating FOB terms to recognize revenue too early.
And OCZ seems to have done a few of those, right?
They did. Under pressure to boost sales and profit margins, their CFO, Arthur Knapp, got into some shady accounting. Despite using FOB destination, which delays revenue recognition, they started recognizing it at the shipping point, prematurely boosting revenue. They also downplayed actual returns, masked discounts as marketing expenses, and misstated ending inventory. Inflating ending inventory makes costs look lower and profit margins higher.
And this had some serious consequences, right?
It did. Their actions overstated revenue by over $102 million and gross profit margins by almost $120 million. Both the CEO, Ryan Peterson, and Knapp received big bonuses and sold stock at inflated prices based on these misleading numbers. This led to a huge stock price drop, and OCZ went bankrupt. Knapp and Peterson had to repay bonuses, faced heavy fines, and were banned from public companies. A stark reminder of the consequences of bad accounting.
Shifting gears, let's talk accounts receivable, the money customers owe. It's considered the third most liquid asset.
Right. Liquidity means how easily you can turn something into cash quickly. Cash is most liquid, then short-term investments, then accounts receivable. Receivables are basically what others owe you. We have accounts receivable from normal sales on credit and notes receivable, which are more formal promises to pay, often with interest.
What entries are made for these?
For a service on credit, debit accounts receivable, credit service revenue. For lending money with a promissory note, debit notes receivable, credit cash.
The material mentions an accounts receivable subsidiary ledger. Why have this extra record?
The general ledger shows the total owed by all customers. The subsidiary ledger breaks this down by individual customer, showing exactly who owes what. The total in the subsidiary ledger must always match the main accounts receivable account in the general ledger.
And notes receivable are more formal agreements than accounts receivable, right?
Right. Notes receivable are like a legal IOU. They're written promises to pay on a specific date, often with interest. Sometimes they're even secured by collateral, assets the lender can claim if the borrower doesn't pay.
What about other receivables? What falls under that?
Other receivables are any claims for money that aren't regular customer sales or formal loans. Examples include interest receivable, which is interest earned but not yet received, money advanced to employees, or tax refunds from the government.
The material has some decision guidelines on managing the risk of uncollectible receivables. What are the key takeaways?
There are a few important points. Weigh the benefits of credit sales, like higher volume, against the risk of non-payment. Credit checks on potential customers are crucial to assess their reliability. Separating cash handling from record keeping prevents theft and errors. And to maximize cash flow, monitor payment patterns, send reminders, and encourage things like electronic transfers for faster payments.
But even with precautions, some customers just won't pay. How do businesses account for these uncollectible receivables?
You're right, it happens. When a customer doesn't pay, the impact is an uncollectible account expense, also called doubtful account or bad debt expense.
Looking at Apple's 2016 balance sheet, they presented accounts receivable less allowances. What does less allowances mean?
Less allowances refers to the allowance for uncollectible accounts. It's their best guess of how much they won't be able to collect. In 2016, Apple had a $53 million allowance, subtracted from their gross accounts receivable to get the net receivables. $15,754 million, which is what they realistically expect to collect. Apple's gross and net receivables were both down a bit from the previous year.
So that $53 million isn't a confirmed write-off, just an estimate.
Exactly. The allowance method is the standard way to deal with this. It's about estimating potential uncollectibles each period based on their experience, economic conditions, and a review of outstanding balances. This expense is recorded as uncollectible account expense on the income statement, and the allowance for uncollectible accounts is set up on the balance sheet. This allowance reduces the gross receivables to their net realizable value.
So the net realizable value is what a company actually expects to collect.
Precisely. It's the gross receivables minus the allowance for uncollectibles, a more accurate view of what they'll likely turn into cash.
The decision guidelines talk about how to report uncollectibles in financial statements. What's the gist?
The guidelines emphasize two things: reporting receivables at net realizable value on the balance sheet, and reporting the expense on the income statement as uncollectible account expense when the related revenue is earned. This follows the matching principle, when you match expenses with the revenues they help generate.
There are two methods for estimating uncollectibles: the percent of sales method and the aging of receivables method. Let's start with percent of sales.
The percent of sales method is simple. You estimate uncollectible account expense as a percentage of total credit sales or total revenue. Since it focuses on the bad debt expense on the income statement, it's called an income statement approach. This percentage is based on historical credit losses.
Let's say Apple, with $215,639 million in 2016 revenues, estimates their uncollectible account expense to be 0.00002% of revenues. How do we calculate that?
Multiply total revenue by the estimated percentage. So $215,639 million times 0.0002, or 1/5 of 1%, gives you about $43 million in estimated uncollectible account expense. The entry would be debiting uncollectible account expense for $43 million and crediting allowance for uncollectible accounts for the same amount.
And this aligns with the expense recognition principle, right?
Yes. The percent of sales method links the bad debt expense to the sales revenue that generated the receivables. By recognizing them in the same period, it follows the matching principle.
Now, on to the aging of receivables method. What's different here?
The aging of receivables method doesn't look at total sales. Instead, it analyzes each customer's outstanding receivable based on how long it's been unpaid. The logic is, the older the receivable, the less likely it is to be collected. It's called a balance sheet approach because its goal is to accurately reflect the net realizable value of receivables on the balance sheet.
Exhibit 5.2 shows a sample aging schedule for Apple. What does this usually show us?
An aging schedule groups receivables by age, like current 130 days past due, and so on. Each group has an estimated uncollectible percentage, increasing with age. Multiplying the total in each group by its percentage and adding those up gives the total estimated uncollectible amount. In Apple's example, it showed $15,807 million in gross receivables and a $53 million estimated uncollectible amount. This $53 million is the target ending balance for the allowance for uncollectible accounts.
So if the current allowance balance doesn't match this target, we adjust it.
Exactly. If Apple had a $5 million starting balance and needs $53 million, they'd make an adjusting entry to increase it by $48 million. This means debiting uncollectible account expense for $48 million and crediting allowance for uncollectible accounts for the same amount. The balance sheet would then show net realizable receivables at $15,754 million. $15,807 million gross minus the $53 million allowance.
What about when a company knows a customer won't pay and needs to remove it from the books? That's called a write-off, right?
Correct. When a company has tried everything and knows a receivable is uncollectible, they write it off. Let's say in 2017, Apple decides to write off $9 million from customer RS and $3 million from TM. They would debit allowance for uncollectible accounts for $12 million total, and credit accounts receivable RS for $9 million, and accounts receivable TM for $3 million.
Yeah.
This removes those specific uncollectible balances from their books.
Interesting. So the bad debt isn't recorded when they write it off.
That's a key point of the allowance method. The expense was already estimated and recognized in a previous period. The write-off just reduces the accounts receivable and the allowance. So there's no impact on total assets, current assets, net receivables, or net income for that period.
So companies might use both estimation methods together?
Often, yes. The percent of sales method might be used for quick interim statements, and then the aging method for more precise year-end statements, ensuring an accurate net realizable value on the balance sheet.
The material also mentioned the direct write-off method. How's that different?
The direct write-off method isn't ideal under GAAP. Unlike the allowance method, you don't estimate uncollectibles or create an allowance. You wait until an account is definitely uncollectible and then directly write it off by debiting uncollectible account expense and crediting the customer's accounts receivable.
What are the downsides of this method?
Two main problems. First, without an allowance, receivables are always shown at their full amount on the balance sheet, potentially overstating assets. Second, it breaks the matching principle because the expense isn't recognized when the revenue is earned, but much later when it's written off. This can distort the financial picture. But for tax purposes, businesses often have to use the direct write-off method.
The material talks about calculating cash collections. How can we find out how much cash a company actually received from customers?
Look at the accounts receivable T account. If you know the beginning balance, sales on account, write-offs, and the ending balance, you can calculate cash collections. The formula is beginning balance plus credit sales write-offs, ending balance, cash collections. But if write-offs are unknown, it becomes an approximation.
Let's talk about notes receivable. How are they accounted for, especially regarding interest revenue?
Notes receivable are more formal. We have the creditor, who lends the money, and the debtor or borrower. Interest is the borrowing cost, usually an annual rate. The maturity date is when the principal and interest are due. Maturity value is the total due, principal plus interest. Principal is the initial loan amount, and the term is the note's duration.
So the lender has a note receivable, the borrower a note payable. Exhibit 5.4 shows a sample promissory note.
Yes. It clearly shows the principal, interest rate, date, maturity date, and who's who. Notes receivable are classified as current assets if due within a year or the operating cycle, whichever is longer, and as long-term assets if due later.
Let's imagine Continental Bank loans $1,000 to Lauren Holland for 6 months at 9% annual interest, starting August 31st, 2018, with a year end on December 31st. What's the initial entry on August 31st?
On August 31st, they debit note receivable L. Holland for $1,000 and credit cash for $1,000, reflecting the exchange of cash for the note.
As of December 31st, we need to account for the accrued interest, even though it's not yet paid.
Right. 4 months of interest have accrued. The interest revenue would be $1,000 principal times 0.09 annual rate times 4 months out of 12, which is $30. So they debit interest receivable for $30 and credit interest revenue for the same. Interest receivable is an asset for the earned but uncollected interest. On December 31st, their balance sheet would show the $1,000 note and $30 interest receivable as current assets, and the income statement would show $30 interest revenue.
When Lauren repays on February 28, 2019, what's the entry then?
The note matures on February 28th. We need to account for the remaining 2 months of interest. That's $1,000 times 0.09 times 212, which is $15. Continental Bank receives $1,035 total, the $1,000 principal plus $45 interest. The entry would be debit cash for $1,045, credit note receivable L. Holland for $1,000, credit interest receivable for $30 for the interest already accrued in 2018, and credit interest revenue for $15 for January and February 2019. And remember, only that $15 earned in 2019 will be on their 2019 income statement.
The material mentions some things about calculating interest. Could you go over those?
Sure. Interest rates are usually annual. When calculating interest for less than a year, consider the time a fraction of the year. And interest can also be calculated using the exact number of days in the period, with 365 days as the denominator for a year. For example, a $10,000 loan at 8% for 90 days would generate $197.26 in interest. $10,000, $103.05.
And remember, notes receivable can arise from sales with extended terms or even from converting an overdue account receivable.
Absolutely. A note receivable gives a more formal, legally binding repayment promise plus interest, which can be helpful for longer terms or overdue accounts.
The final learning objective is about evaluating liquidity using receivables-related ratios. Why is liquidity so important?
Liquidity shows a company's ability to pay its short-term debts on time. A liquid company is less risky in the short term. On the balance sheet, assets are usually listed by liquidity. Cash first, then short-term investments, then receivables.
The material introduces the quick ratio as a more stringent measure than the current ratio. How do we calculate it, and what does it tell us?
The quick ratio, or acid test ratio, considers only the most liquid assets. It's calculated as cash and equivalents plus short-term investments plus net receivables, current liabilities. Apple's quick ratio is 1.05. $20,484 million plus $46,671 million plus $15,754 million, $79,006 million, which suggests good liquidity. The benchmark is 1.1, meaning $1 of liquid assets for every $1 of short-term debt.
But what's acceptable for a quick ratio can vary, right?
Yes, it depends on the industry. For example, retailers with high inventory turnover might have lower ratios than manufacturers with slower moving inventory. Also, different credit terms or financing arrangements can lead to different typical ratios. Auto dealerships, for example, often have lower ratios because of their specific financing arrangements.
What about the accounts receivable turnover ratio?
The accounts receivable turnover ratio measures how efficiently a company collects its receivables. It's calculated as net credit sale average net receivables. A higher number means faster collection.
And then we have the days sales outstanding, DSO ratio. What does that tell us?
DSO shows how many days, on average, it takes to collect receivables after a sale. It's calculated as 365 days accounts receivable turnover. A shorter DSO is better. Apple's turnover for 2016 was 13.23 times, $215,639 million. $15,754 million plus $16,849 million. Their DSO is 27.6 days, 365 days, 13.23.
So is 27.6 days good or bad for Apple in 2016? What do we compare it to?
Compare it to their credit terms and industry averages. If their terms are net 30, then 27.6 days is excellent. Also, compare it to their own historical DSO. A rising trend could signal problems. As the material says, slower collections might force a company to seek alternative financing. There's also a different DSO calculation method mentioned in footnote 7.
Lastly, the material has an end-of-chapter summary problem for Excelsior Technical Resources. It seems like a good way to apply these concepts.
Yes, it's a detailed scenario where you calculate net realizable value, prepare journal entries for estimating and writing off uncollectibles, analyze T accounts, and understand how things look on financial statements. A great way to test your understanding.
This has been a thorough look at revenue and receivables. We covered the fundamentals of revenue recognition, including the 5-step model. We looked at sales returns, allowances, and discounts, as well as accounts receivable and methods for estimating and managing uncollectibles. We also touched on writing off uncollectible accounts and the direct write-off method. Then we moved to notes receivable, how they're handled, and how to calculate interest. Finally, we explored liquidity using ratios like the quick ratio, turnover ratio, and DSO.
A solid grasp of these concepts is so important. It helps you truly understand a company's financial health, efficiency, and overall performance.
So here's a question to think about. We talk about the percent of sales and aging of receivables methods. Beyond the technical stuff, why might a company prefer one method over the other? Think about the impact on financial reporting and how it might influence stakeholders' decisions. We encourage you to examine company financials you encounter and see how these concepts are applied. Thanks for joining us.